If I had to retire in 2026, here's exactly what I would do. Everyone needs to understand there's only three things that money can do for you in retirement. Number one, create guaranteed income for the rest of your life. You need a paycheck that consistently comes in, whether you're sick, whether you're on vacation, or whether you're just living your life, even in the biggest unemployment phase of your life. Number two is going to be safe growth. Why do we need safe growth? We need safe growth to hedge against inflation. We need safe growth to hedge against unexpected costs, like maybe long term care. We need safe growth to hedge against fun and extracurricular activities, and maybe even emergency money. And number three is going to be legacy. Obviously, if you have beneficiaries and you're planning to leave some sort of legacy to them, you want to go ahead and just plan that as best as possible. You want to plan it in a way where it's still accessible to you, but if you pass away, it's very easy to parent from the grave or to distribute to your beneficiaries correctly. So let's go over phase number one, income. That is the most important part of this three-part planning. Income is what's going to make sure that you cover your bills, continue to live the lifestyle that you want to live. And here's the goal, is to create that guaranteed income with the least amount of money possible. Okay? And that's why I highly recommend dealing with an expert. An expert's going to use strategies, not just put your money somewhere that's going to feed you a guaranteed income, but strategize to make sure that they can juice any product for as much money as possible so that you win. Okay? The other thing is you want to make sure that you cover your spouse. At the end of the day, it's all fun and games until the inevitable happens. One of you passes away and the other surviving spouse has to make sure they still cover the bills, even in the time of mourning. So we want to make sure we cover them as well. So thinking about that, it's basically just finding out what your target income is going to be. And it's pretty simple. All you have to do is decide what is the current lifestyle that you're comfortable living today, understand what it is before and after taxes. Once you set that number, you can basically reverse engineer it and decide how much is it going to take, how much of my assets is it going to take to create that number. Now, we like using annuities because annuities are one of the only ways in this nation to optimize your guaranteed income for life, to create a personal pension. Also, you want to deal with someone that understands how to optimize Social Security. There's a few different strategies that you can implement when it comes to receiving Social Security to really take advantage of the tax-free portion of it, or the COLA, cost of living adjustment that you receive every year based on, CPI or Consumer Price Index. If you understand that, then you can plan with less moving forward out of your own assets. Another recommendation to plan for income is to understand that for every year that you continue to work, you increase the success rate of your actual income plan anywhere from 5 to 10%, which means the less you deplete your accounts, the more longevity you're going to have. So I highly recommend taking in consideration continuing to also work a part-time job or something that you really like to do on a part-time basis that can help you stay focused and not necessarily deplete your retirement accounts as quickly as possible. Now, when using annuities, you need to understand income riders, and you need to deal with an independent annuity producer that has access to a broad range of products so that you're not limited to the product selection that maybe a captive producer would only have access to. What does this mean? You want to be able to shop your situation to receive the highest potential income payouts in the nation. You also want to work with an independent advisor that understands strategies such as withdrawal strategies, which means sometimes it's better to continue to let the income rider continue to build on your money at the same time using manual withdrawals out of that account or maybe another account to let the income rider continue to build up. Very similar to Social Security. Every year that you wait, your income increases by 8%. It's going to be the same process with annuities. The more you wait, the higher the guaranteed lifetime income is going to be. Once you decide that you have a plan for the income, now we can laser focus on the safe growth and the ability to leave legacy for your future beneficiaries. The goal here with safe growth, which is number 2 objective in retirement, is going to be peace of mind or sleep insurance. Here's how you know you built a solid plan. If you can sleep throughout the night, not stressing about what's going on with the ups and downs of the growth part of your portfolio, then you have a solid plan. Otherwise, your plan's broken. So let's talk about that. What is safe growth? Safe growth is consistency with zero potential downside. That's what we call safe growth. We're not here to compete against, the market and the big blue chip stocks and, compete against the aggressive portfolios. We're here to make sure that we preserve and continue to beat inflation every year, year in, year out. By doing that, we put ourselves in a positive situation no matter what the economy is doing. So if we've already solved for the income, we can actually be a little bit more aggressive with the growth side. In this video, we're not giving investment advice. You're going to want to see your investment advisor and actually have your portfolio reviewed. But we're going to give you some suggestions that we believe are going to put you in a phenomenal positive situation. Number 1, part of safe growth is making sure that you hedge for emergency funds in the future. And part of emergency funds in the future is long-term care. You want to make sure that you have dollars available to you to take care of in-home services or adult care or senior care or potentially hospice, okay? Because this can become a really big, cost that will deplete your portfolio pretty quickly if you don't plan ahead. There are hybrid products out there in today's world that not only operate as a living benefit, which means they have cash value properties to them, but if you go into long-term care, it has the tax-free payment that's going to be consistent to cover all your long-term care needs. This includes life insurance with long-term care riders and hybrid long-term care riders on indexed annuities. If you have an independent advisor, you're going to want to look at these products because not only do you continue to grow your money based on the index options that they offer, but you're able to continue to have access to them throughout the payments, which means you don't lose control like the standard old school long-term care policies, which were, if you didn't use it, you lost it. So by implementing a little bit of the growth into these products, you're going to hedge for so much more benefit in the future where you're not going to have to deplete all your cash or investment accounts to pay for your long-term care. You're going to have something separate that's going to be able to cover that cost when it does come. And let me just tell you this, it will come. There is no way that you are not going to be able to enjoy long-term care benefits in the future, knowing that some of these benefits can simply be activated by not being able to perform 2 out of 6 active daily living activities. And this includes bathing, showering, eating, transportation, being able to dress yourself, and simply go to the restroom. So if you can't perform 2 out of these 6 activities, you're going to be able to receive long-term care monetary benefits to be able to have the services that you need. But if you don't use that, your cash and your accounts are still growing at a consistent rate with no risk of loss. So make sure you look into these policies as part of your safe growth plan. Otherwise, make sure that you're growing your plan as consistently and as aggressively as possible by diversifying correctly with different types of investments. Number 3, if I were to retire in 2026, here is number 3, the third objective in planning for retirement in 2026. I want to make sure that I have a legacy plan, which means I want to put some sort of money aside that allows me to buy dollars for pennies to be able to allow me to give back to my beneficiaries and help them continue to enjoy life. As a parent, I want to make sure that if I die while I still have dependents in the home, they are taken care of, okay? So these two objectives, which is legacy and making sure that if there is a dependent, they continue to be parented even after I go to the grave, are very important to me. So obviously life insurance is going to be a big part of this third part of retirement planning, okay? But there are indexed annuities that allow us to plan for legacy even when we can't get approved for life insurance policies. You're going to want to look at these hybrid policies that allow us to have what's called death benefit riders or death benefit payouts based on the account benefits that they have. And this also allows us to hedge for death benefit even if it's qualified funds, which means pre-tax dollars. We need to understand that pre-tax dollars cannot help you purchase life insurance. So by understanding the qualification of our dollars, we understand what product selection can we invest into. And all of these products are protected against probate, which means you don't have to go through the court system to allow your beneficiaries to receive access to these funds. And most of them are protected from creditors, lawsuits, or bankruptcy. So not only are you adding additional protection to your dollar, but you're also making sure that your beneficiaries receive it as quickly as possible. So make sure you look at these hybrid index annuities that offer death benefits, or obviously if you can qualify for life insurance, make sure you put something in place that's going to help your next generation receive the funds as quickly as possible and as big as possible.